Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Erik Wetterling, also known as the Hedgeless Horseman. Runs the hedgelesshorseman.com, and we will put a link to that down below so you can follow along with Erik's work. And Erik, it's good to have you on the show again. We were having a long chat before this one today just about market sentiment, about the way the stocks have performed throughout the course of this year, and it has been a bit of a roller coaster. But one of the takeaways, and we probably just looked at, 20 charts, 30 charts of different companies, and we were just making the point that a lot of the companies have been in a bottoming process really for, let's say, over a year, where they were kind of bouncing along the bottom, especially the more established companies. And so they'd go down, they'd pop up, they'd go down, they'd pop up. But there was a long period that investors could have been accumulating before the big rise that we saw really coming out of the end of February, beginning of March, really the PDAC time period. Then they shot up for a couple of months. And we're looking at a lot of these charts, and honestly, even though they've rolled over lately in this corrective move the last, let's say, month or so, a lot of them are still at much higher levels than they've been over the last year. So it just drives home the point of value investing, buying and accumulating companies or growing your position during weak periods of time. And you don't have to be an expert, and you don't have to time it right, and you don't have to catch the perfect low or anything like that. You just have to accumulate a good cost basis before we see these moves that really do start to outperform. So I guess let's maybe start there. What is your reflections after what we've gone through in 2024 as far as the sentiment and people's reaction to where they bought, where they sold, that kind of thing?
Yeah, to begin with your point about some of these have been basing for a year or maybe 2 years. Some of these juniors, every buy over the last 2 years would be in the green right now. That's assuming you buy, but it's that's quite some margin of safety, I was going to say. It's you get 1 to 2 years, you could buy pretty much at any point, and all of a sudden, after a 3-month rally or even a 2-month rally before this latest dip, you would be green in all of them. That's kind of, we've talked about this before, I think, that, 80% of the time the sector sucks, 20% of the time you make the money back, and maybe more than that. It's not in every single stock, obviously, but I see a lot of belly aching right now. People already, because of this latest dip, it's dead cat bounce going to continue for 4 years. People are very much not happy. But if you look at the compounding pace, even with this dip, there's a lot of stuff that's still up 100% or more from the lows. 100% for every 3 months. That would be a 16 bagger over 12 months. So this is an insane compounding rate, actually. If we kept this pace that people are already complaining about since the lows, we would be billionaires in 3-4 years. So I guess it's important for people to understand. It's this sector is very weird, but nothing goes straight up. It's yes, we went lower than we should. We probably made more money in the 2 to 3 month rally than, quote, we should. Well, in a sense, maybe not, because they were undervalued. So it's one could say that you don't really need a catalyst for it to go higher. But it's my point is I'm quite happy with this. If I could keep this pace up, my goal is to compound 50% per year. A lot of these juniors have done more than 100% in just the last 2 to 3 months, and people are already complaining. And it's okay, why are you complaining? If you look yourself in the mirror, it's I understand that there's a lot of stocks that are still down a lot from the multi-year highs. Some are still down 80% or whatever. But did people actually do the basics of oh, this sector just gets cheaper and cheaper over the last 1 to 2 years? Did you actually average down? If we look at the volumes, they were kind of record low. So it doesn't look like people actually did buy the low. So, okay, if you didn't buy the low, then it goes up. And what are you doing then? Buying in again? And now we get a dip. So my point is kind of that there's a lot of complaining and all that, but it's important for ourselves and our investing career to be honest with ourselves. Did I actually buy? Now in hindsight, I had 1 to 2 years. I could have, say, in some stocks, I could have bought at any point in time and I would be green on all of them. So if I average down over 1 to 2 years, okay, my portfolio goes up and my average cost goes down. All of a sudden, some of these rip 100%. That should have made a dent in the portfolio, assuming, again, one did actually do what the old saying is, buy low, sell high.
Yeah, great point. And I think it's also the nature of investors to view the whole market through their own personal portfolio. And I think we all do that to some degree, but I think sometimes it's good to take a step back and just pan back and look at the broader sector and see, did it work? If we look at the ETFs, we saw that they did outperform the metals, maybe not as an extreme amount as people wanted to see, but the point being, you still would be up as an investor. The goal of investing is to make money. And a lot of these stocks, the more established mid-tier companies, the smaller producers, some of the developers, some of the big advanced explorers, and even some of the hot exploration plays had a nice move. But putting it into a bigger picture context, this could have just been the very first move, and hopefully it is just the very first move of a longer process. The nature of investors, though, is to wait until they see the proof. And Erik, you've pointed this out on our show so many times before that people will watch a bottoming process, not buy it. Then something jumps up 100, 150, 200%. Then they buy it, and they end up buying the intermediate top of the very next little run there. So maybe just speak to that about, it's not just about stock selection. Sometimes it's about how one buys, how one averages into positions.
Yeah, I mean, seriously, as you said, I talked about this a lot. It's like, I know for a fact there's 100% chance we're going to have a rally in the junior sector again. So that's my assumption. So I just, kept buying, and I still buy. I just keep buying, and I stock pick. So I try to buy the ones that I think are the cheapest of them all. So I think all of my juniors are really, really cheap. And that's my only guiding light. And that's going to also mean that I'm going to be buying high. I bought, every single top basically since 2015. It's just that I also buy the bottoms. I increasingly buy the bottoms. The cheaper something is, the more, let's say, greedy I get. So I make sure to, let's say, invest even more and get even more active when it comes to value shuffling, because there's 100 opportunities out there. Instead of at the tops, you might know 5 stocks that you still think are actually undervalued. So it's you can afford to buy the highs, but only if you can buy the lows as well. And it's I never know when we're in a bull or a bear market, really. It's we'll know that when 2/3 of the move is done. 3 months ago, did everybody know it was a bear market? Obviously, look at any chart. It's the juniors had been terrible, all the minors had been terrible. So everyone agreed it was a bear market. Well, okay, that's when you should be buying. Now people are not still, are we in a bull or a bear market? I have no idea. If we go up 100, 200% more from here, yes, then I can look back and say, well, the February bottom, let's say, was actually the start of a bull market. But then, of course, it's way, way too late to do anything about it. You can't go back in time. So it's I don't think you need a lot of market timing. I just think you need to remember that this is a broken clock. This sector, like Pierre Lassonde says, always crashes and always rallies. So when it's already crashed, you have a pretty good idea where you are.
Well, and I think another factor when you're looking at crashes, it doesn't have to be perfect, but there is a seasonality to the metals. And so it's interesting to see that in the summer here, we're in the proverbial summer doldrums. We've just had a 1-month corrective move off those highs. So the highs that were made up until about May, most of June we rolled over. Now we've switched to July. We may still have some weakness, but we were talking about the seasonality and news flow from companies. So if you're into the exploration stocks, a lot of the drill season just started a month ago, maybe 2 months ago. And so the results are going to be coming out over the next couple of months. And if there are surprises, if there are assays that come back that really pop people's eyes in the market and they say, holy cow, look at this company, they're going to be chasing those stocks rather than having positioned in them during this slow period. So maybe to speak to the seasonality that we're in right now in the summer doldrums.
Yeah, you told me the saying that, never sell a boring market. Because, we know how typically it is. Something consolidates and, there's not much trading, whatever. And then something happens. All of a sudden, sentiment goes from almost zero to high. So we're in a boring period. We haven't had the first, let's say, correction after the 2-month rally. Some juniors have corrected, maybe twice or whatever. Still, I see this is potentially the first stop. Already sentiment is getting worse. Okay, people are bored. I'm bored out of my mind, I gotta say. It's summer is here. I don't look at metals that much. I'm just happy since I think I own stuff that's really, really cheap. I don't feel like I have a problem in the world in a sense, because the way I see it, it's just a matter of time before these revalue. I don't know how they will revalue, what pace they will revalue. Again, I'm happy with 50% per year. not 100% every 3 months. So I'm already happy from that perspective going from the last bottom. But okay, so we have a boring market, boring sector. Silver is just, churning basically around $30, whatever. Gold is, holding steady. Metal prices are quite good, so we can't be complaining about that really. Performance over the last 2-3 months in the unit is pretty good, but we're all already getting bored because people are still probably underwater, yada yada yada, and the negative sentiment goes out on Twitter where people are already talking about dead cat bounce and all that. So we have a boring period. Nobody cares. Everybody's out on vacation, whatever. There's not too much news. There's mostly a bunch of soft news, like we've started drilling or we're preparing to drill, whatever. But going from, let's say, metal prices are still high, stuff out there is still cheap. Everybody's bored out of their minds, including myself. And we're going into the latter half of the year, which is typically the heavy assay season. And this time, in contrast to last year, I think some juniors have more money, etc. So I think still, not from only a valuation perspective of the the beta plays or the more de-risked advanced ones, I think we're in for a pretty good season from potential shock value from catalysts, because I think we will have more catalysts this year than last year, and nobody's prepared for it.
Well, Erik, also admittedly, there's a lot of companies that didn't raise money or are still waiting to, and they don't really have a good work program. But then there are those companies that clearly are cashed up, they're drilling. They may have a bigger drill program than last year, or they may still just have a substantial drill program. But they're going to have news flow, and it's probably going to last 3 to 9 months, depending on the company, depending on the meterage, depending on what they're drilling. Do you think it's a good idea, or in your own portfolio, are you looking at moving out of the I would call them the have-nots, the companies that just don't have cash to do any news, and putting it into the companies that are the haves, the companies that have the cash flow, they have the drilling on tap? Is that where investors should be focused to capture whatever those catalysts are coming up?
Yeah, I mean, I would say so. At the end of the day, it's like I see it as, you're constantly kind of high grading your portfolio. I mean, I know a lot of people don't want to sell stuff they're down in, because then it's like, oh, okay, I sell something and down 60%. Well, I'm not going to get that money back from that stock, obviously, since I sold it. I have no problem doing that, because what gets me greedy is like, you have some other case where, let's say, the project is better than ever. They've raised money. They're, continue to drill. So you think there's a pretty good chance that they're going to find something more. And in your mind, well, it's like this story is intact. If they just keep drilling and doing this work, let's say, hey, in 2 years, they might have multiplied the value. So it's like, how big of a deal is, minus 60% in that case, assuming it's like, oh, I used the money, the 4K out of 10K that I had over, invested in a junior where it's like, I see, potential upside of 200 to 500% or more over the next 2 years, depending on the sentiment levels, of course, because that's a large multiplier. It's like, is that really a problem? No, I don't think so. It's like, I'm very much in favor of, again, constantly having your positions be the stocks you're most excited about. It's like, I have a higher lose rate, let's say, on stocks than I have win rates. It's just that the wins, they pay for a bunch of losers, because a stock can go up more than 100%, but it can't go down more than 100%. So I was like, yeah, I would say that's a good idea. If you know a stock that's like, they don't have any money, and you think it's going to be an outrageous dilution event coming, whatever, maybe find something that has money. It's still cheap because nobody cares. And you think that, hey, they have a pretty good shot of actually finding something. But then, of course, there's also cases where it's like the market knows this is going to dilute. But even if you add like 20-30% dilution, and that's pretty big most of the time, maybe it's just too cheap. So it's like, hey, there's a financing coming, there's a dilution event, but it's like the market has so over discounted that fact, because that's the only catalyst people are looking at. Then it's like, hey, I should be in this, because as soon as they have money, people are going to again appreciate that, whoa, I mean, they can do a lot of, quote, damage with that money going forward. Again, it's like, as always, a case by case basis, which was also your point earlier, that it's like every single stock hasn't done X or Y. It's like it differs, and most of the time it differs type of company it is. I mean, let's say Beta has done better than Explorers and all that, and that's also going to change, by the way. I mean, there's cycles within this sector that is cyclical to begin with. But yes, short answer, I would say is like, yeah, if you find stuff that's simply better than what you own, I mean, that's what you really should do every day. I like this saying that you should not have any holds or especially not sells, actually. I mean, every single stock you own should really be a buy. It's like you would be happy to buy it today. Not only that, things might work out, they might turn around, and you have some obvious buy that you're not buying because I don't want to take a loss. I mean, you're shooting yourself in the foot.
Yeah, Eric, I think that's such a good point. I like the example of use of just a simple math one of like if somebody put $10,000 into a company and it's down 60%, so they've only got 4,000 left. They could take that 4,000 in this example and put it into a company that thinks it's going to go up 3x. Well, now they got 12,000, or 4x. Now they got 16,000. But the odds of them getting from 4,000 back to 10,000 in the stock they're in probably aren't that good anyway. So the biggest thing to do would be to cut a loser and put it in what could be a winner based on the news catalyst and the work strategy for this year. Difficult to do that, but this may be the time to consider that while we're in another corrective period. Any other thoughts you'd leave people with as far as, I know you do a lot of videos, and people should go check out Erik's YouTube page. He puts out some interesting rants and thoughts on the markets, but you often look at these markets and do copium videos. Is there anything else you would say on the psychological side to help investors just manage the volatility in the space a little better?
I mean, that's the hardest thing, as always. I mean, it's like, I don't know how many copium videos I've done. It's like kind of repeating the same message, but still people seem to need it. And it's like, I kind of need to remind myself of that stuff. That's like, okay, it's boring, whatever. You know, a stock you like when it's going up, you feel great, you feel smart, and then it has a correction. And you know, there's like the saying that if nothing changed and you liked it at price X, it's down 20%, you should love it even more right now because it's gone down. But it's like in practice, we do get affected by that. Again, it's like, do the due diligence, do the conviction. I like to calculate some base cases where it's like, oh, hey, my base case, or there's a range of possibilities. This could either go down minus 100%, but I want to see a fat upside potential. The more probable, the better. In that case, if you have a spreadsheet or whatever, it's like, okay, this case, I think that could be worth this much, or this could happen, whatever. And you see like hundreds of percent in revaluation potential. Yeah, I think you're going to have a much easier time to buy when it goes down in price. But that comes with if you have conviction. So it's like you have to really do the work to get conviction, because if, like now, for example, you've done the work, you have high conviction, you know why you bought something, not just because someone said it's like I like this or I bought this, so you have no conviction really. If you really understand why you like this or should like that, I think it's much easier to just enjoy summer right now, for example, because in your mind you're sitting on it's a loaded dice kind of. It's like you can't really lose. You're just waiting for the inevitable. And in that case, you can afford to go out and enjoy the summer, because I'm not worried about the stocks I own. Something can happen that can make them overvalued. It's like the case doesn't play out, whatever. But until news comes and changes my view of the value, if they go up or down 5-10% now, that's a rounding error, because like my future scenarios, especially if the longer you draw out the time frame, it's like, hundreds of percent higher than this. So it's like, well, the case in your mind is like a 2-year case. So all you can do really is wait for 2 years and check the news releases. Until then, there's not much else to do. It's like you're just waiting for the inevitable in your mind. And that comes from conviction, that you're 100% sure in your head that this is cheap, which makes it much easier to buy and hold. But that doesn't mean you're going to end up being proven right. But it sure helps with buying low.
Yeah, some great points, Eric. And I think it's a good point on having the due diligence done in a company, the management team, the project, where you feel very solid about it. Not that there can't be problems in the mining industry, there always are. But if you have the conviction there, you really can do a set it and forget it and enjoy your summer, as you say, because stewing about it every day and watching every 5 and 10% move is really not helping you as an investor. You almost may be better off if you just did leave for a year or two and came back and checked it, compared to micromanaging every single news release and every single thing that happens in these stocks once you've already built conviction in the story. So some interesting thoughts for people to consider. I hope this is helpful just to give people a reflective moment here as the markets have corrected the last few weeks. And looking forward to our next conversation, Erik, where we get back together and dissect these markets again.
Great talk, Shad. Thanks.